Paul, go ahead. Tell us your just overall general stake idea on dividend stocks, why people are
We're
drawn to them.
We're going to do more than just general.
Go ahead. Oh,
okay.
Please do.
So dividends, when a company earns $10 in a year, one of the ways in which they can pay their investors, because most times if somebody earns $10 and they keep it, it's called retained earnings, the money in the company, you as an investor might sit there and say, well, I'm not seeing any of it. You really are seeing it because you're owning a piece of a company that's building up a cash pile. But obviously, not everybody learns from everything money, so they can't learn from me. They want to see some sort of money back in their pocket. So a company will pay a dividend. Let's say, for example, they take $10, they make $10, they pay $2. They're paying out 20% of their net earnings into dividends, okay? That is their way of saying, hey, thank you for being an investor. We're going to give you some money. It's in your hand no matter what happens. Dividends over long periods of time have been shown. I think I read a stat somewhere. If you only bought dividend-paying stocks since 1928, you'd outperform the S&P by something like 2.5% a year. I don't know how true that is. I've never back-tested it. I've never looked at it. First off, because the S&P 500 didn't even exist in 1928, so it would be based on S&P 500 comparables, et cetera. But dividends are a great way for an investor to feel like, hey, I'm getting a check. I'm getting something for my return. Even if the stock price is stagnant for a long time, I might be getting 3 to 4% or whatever the number is right now. Keep in mind, the S&P overall is paying about a 1.6% dividend. So if you own SPY or all the companies individually, you're going to get about 1.6% per year on your money.
SPY is the S&P ETF?
Correct.
Okay.
So that means if you have $10,000 invested, you can get about $160 a year. Okay? Not great, not bad. Now, historically, that number is usually around 4% if you go back to like 1870. So it's pretty low right now. However, the one thing I always urge people caution. I remember a story in 2004, I was buying my first piece of real estate. And my lawyer was the trustee of some trust. And he was told we need dividends. So he's like, oh yeah, I went in there and I just searched. High dividend was GM. And I was like, well, do you think the dividend is safe? He said, well, of course it's safe. They're paying it. They wouldn't be able to, if they're not able to pay it, then that's how, I'm like, okay, that's not true. A lot of times what a company will do is they will do what's called create a dividend trap, or will have a dividend trap scenario where the stock price plummets. So if, let's say, for example, the stock is at $50 and the company pays a $2 dividend, that is 4%, right? Right. Now what happens if the stock price goes to $25, call it $24? Let's call it $20. They're still paying the $2 dividend. Now it's a 10% dividend. That's pretty good. Mm-hmm. What companies might do sometimes is go, hey, you don't need 10%. We're going to cut this dividend in half. You're still making more. You're getting 5%, and we're saving cash that we can use to grow the business, et cetera. But what you need to know is it even a supported dividend? We talk about this all the time. Can the company actually support the dividend? Free cash flow. We always talk about this, guys. This is my favorite metric. Free cash flow is cash from operations less capital expenditures. Now, this cash at the end of the day, they use to pay dividends, make acquisitions, invest in more growth, hire people, etc. But if this free cash flow number is less than the dividend amount, you have a problem, even if it's not less. So let's say, for example, there's a company, and let's say the company has a market cap of $10 billion, and they pay a 2% dividend. That means every year, they're responsible for $200 million in dividends. What you want to see is you want to calculate their free cash flow and make sure it's a pretty healthy amount above this number. Because if it's, let's say, for example, they have $220 million, that's not much room to go with. You're pretty tight here. Any sort of backlash, any sort of like fall in revenue or profit, it's going to cause a problem. Let's say they make $1 billion a year in free cash flow. That's pretty solid. They're only paying out 20% of their free cash flow. Now, your next question might be, okay, well, what's a good metric for that? I don't know. It all depends on so many factors. Does the company have a good gross margin? Do they have a good profit margin? Do they have increasing debt, decreasing debt? How much debt do they have? How much is going? There's so many factors. The less you know, the higher you want this margin to be. You've seen me when I talk about it. Whenever we talk about a company that has dividends, we say, how safe is this dividend?
And if this sounds if this already sounds confusing to you, We welcome you to follow along the channel, subscribe. We will show you how to calculate the free cash flow growth. Paul opens up the Y charts and shows you exactly the calculation, how much money they have and can they pay out their dividend. This is part of our 8-pillar analysis that we do on our show. If you're new to us, Paul, talk about the 8 pillars and what our patrons are getting in the future.